Welcome back to Quantify Your Career. Today, let's build a project related to time series modeling. So this is a two-part project, and this is part one of that. Now, if you're trying to understand how quantitative analysts think about how we use prices and return data in terms of time series modeling, this video and this project is for you. Whether you're in high school or just curious about what the field looks like, or whether you're an undergraduate mapping out your path, uh, you can use this project. And it is beginner friendly because I'm going to teach you some fundamental concepts first and then build onto this. So the project has two parts. Part one is entirely in Excel because this is where you will actually understand it. And when you can trace a formula cell by cell, when you can see the number change when you change one input, that is, I feel, that is when the concept clicks. And what in my experience I have seen with myself as well as students who are MFE students or engineers transitioning into quant roles, and even people preparing for quant roles, if you don't work with Excel first as an intuitive step, you might struggle to explain your own Python output later. So that's why we are starting with Excel, building the intuition first. Part two will be a Jupyter notebook in Python. Now, what we will cover in part one is, in the first section, what are financial returns? So we answer the question of why we transform price data into returns before modeling anything. Then in the second section, we talk about some facts. These are statistical properties that show up consistently in return data. And understanding these will tell you, before you even run any model, what kind of model you need. Then section 3 is stationarity. This is the concept that trips up more people than anything else in time series. We will make it completely clear with a side-by-side comparison. Then in the fourth section, we talk about autocorrelation. We compute the ACF, the autocorrelation function by hand in Excel using one formula. And then we have two tables, one for raw returns and one for squared returns. And then the contrast between them is the reason GARCH exists. And we'll come to all of that later. Then in section 5, we build AR1, MA1, and the ARIMA models in Excel. We will fit it to a simulated return series and see what it finds. And the result of this is actually the finding is not uh, it's not something which is very helpful, and that is expected. And that is what brings us to section 6, which is the GARCH motivation. So this is where everything will connect, and we'll show why volatility is not constant. And we build the GARCH model. We derive daily risk estimates and run a formal backtest to check calibration. Now, one important note before we start is the data in this workbook, Excel workbook, is a simulated illustrative series. So it is not a real historic data from any actual index. And I have done this deliberately. Real data adds noise and distracts from the concepts. And the concepts are what we are here to understand. And the numbers come from a controlled simulation here. Okay, so let's go to section 1, which is returns. So the first thing I want you to look at is the data structure. Column A is dates, column B is prices. Columns C and D are two different ways to measure how much that price changed from one day to the next. Column E shows you the difference between those two measures. So let me ask you something before I explain any of this. Imagine someone tells you a price is $4,500. What does that tell you? Let it be a stock price or index price. It doesn't tell you much. Is that high or low? And what is it compared to? And when do you compare this? So a price on its own without context is almost meaningless for modeling purposes. And that's why we use returns. A return tells you the percentage change from one period to the next. That makes it comparable across time and across different assets. So 1% move is going to be a 1% move regardless of whether the price was $10 or 4,500. So we always transform prices into returns before we model anything. So the question now is, what kind of return? Simple returns versus log returns. So you see here, column C is the simple return. The formula is today's price minus yesterday's price divided by yesterday's price. This is the standard percentage change you already know. Column D is the log return. And the formula is the natural log of today's price divided by yesterday's price, and then you can multiply it by 100. Now, there are some reasons why we use or why we prefer log returns. First is additivity. So log returns add up across time. Look at the proof section on the right side of the tab. Day 1 log return plus day 2 log return equals the 2-day log return calculated directly. And this is exact. This is not an approximation. So that's why they add up. But simple returns, they don't have this property. Now, if you add two simple returns, you get a slightly wrong answer. Compounding works multiplicatively for simple returns, but additively for log returns. Now, this matters because if you want to aggregate daily returns to weekly or monthly, which is what you usually do in quantitative finance, you can just sum up the log returns. And so this is a huge practical convenience for modeling. The second reason is symmetry. If you earn a log return of plus 10% and then lose 10%, you're back to exactly where you started. This math is symmetric. With simple returns, a plus 10% followed by minus 10%, it gives you 1.1 times 0.9, which actually equals 0.99. So means you have lost 1%. That asymmetry makes the math harder to work, and you prefer symmetry here. The third reason is approximation. So for small daily moves, which is most trading days, the log return is almost identical to the simple return. So if you look at column E, which shows the difference between the two, on normal days, it is essentially zero. So we get all the mathematical benefits at almost no practical cost. So this is why every time series model in quantitative finance is applied to log returns, not prices, and not even simple returns. Now look at column D. You will see values bouncing roughly between -2 and +2 on most days, with occasional larger spikes. The series oscillates around zero with no clear trend upward or downward. Notice there is no drift here, no systematic direction. And this is what you would expect from a stationary return series, which we will talk in the other section. But first, let's go to section 2 to look at what are the consistent statistical properties of a series like this. And all this is really important when you're doing time series modeling, understanding the data and its properties very well before you actually go into the financial model. Now, stylized facts are statistical properties that appear consistently in return data across different time periods. Not because any theory predicted them from scratch, but because researchers observed them repeatedly in real data. They are empirical regularities. So I think of stylized facts as like the fingerprint biometric of financial return data. Before you choose any model, you should look at this fingerprint and let it guide you. So these facts will actually tell you why ARIMA is not enough and why GARCH is necessary. And I'm not saying that ARIMA is not useful anywhere. There are other applications, but for our kind of time series modeling, GARCH is actually going to be more useful. Now, look at fact 1. Returns, they look like random noise. So look at the return series plotted over time. It oscillates around zero. So there is no clear upward trend, no clear downward trend. Today, being positive tells you almost nothing about whether tomorrow will be positive. And this is what statisticians call near zero autocorrelation in the raw returns. And we will quantify exactly how small it is in the fourth section. For now, just remember the series, it looks like noise. You can visually see it. And this is consistent with the idea that return data is approximately unpredictable in direction. So if returns were strongly predictable, everyone would exploit that pattern and the pattern would actually disappear. So near random behavior is something we actually expect. Now, the second fact or the statistical property of this time series is fat tails, leptokurtosis. You must have heard of kurtosis term, which is a moment of the time series. And if you see this histogram here, column H gives you the bin counts. Column I gives you what a normal distribution would predict for each bin, given the same mean and standard deviation. Now, if you compare the two, the actual distribution has a sharper, taller peak in the center. But more importantly, look at the outer bins. So return of -3, -4, -5%, they happen far more often than the normal curve would predict. And this is what fat tail means. And this technical term is leptokurtosis. It is actually a Greek word for heavy. So the tails of the distribution are heavier than normal because the extremes happen more often. Think of it this way. If you modeled return behavior using a normal distribution and you built a risk model on top of it, you would consistently underestimate how often extreme losses occur. And that underestimation is not a small rounding error. It is actually a systematic bias towards believing that things are safer than they are. Risk models which ignore these fat tails, they fail badly in extreme market scenarios. And that is why this statistical property is very important. The third property is small autocorrelation in raw returns. We touched on this already a little bit before. So today's returns give very little information about tomorrow's returns. We will measure this precisely in section 4 when we compute the ACF. The lag 1 autocorrelation on this simulated series is around minus 0.17, which sounds non-trivial, but the R squared that corresponds to this is about 3%. This means, in plain language, that past returns, they explain about 3% of the variation in future returns, which means 97% is unexplained. So for now, just understand this, that ARIMA, which models the mean, is going to find very little structure here. So this is that's actually not a failure of the model. It's an accurate description of the data. We come to it in the other section. But remember this as a statistical property of the time series, that there is small autocorrelation in the raw returns. The fourth one is volatility clustering. This is an important statistical property. If you look at column C, which contains squared returns, uh, now if you are wondering why squared, squaring actually removes the positive or negative sign and leaves only the magnitude of the move. So big moves become big numbers, big positive numbers, and small moves stay small. So now look at those squared values over time. So big values here cluster together, if you see. Then there are long stretches of small values. Then another cluster of big values. This is not random placement. Large moves, they tend to be followed by other large moves. Calm periods tend to be followed by more calm periods. This is volatility clustering. And it is the single most important this stylized fact or statistical property for risk modeling, which we should know. And the implication is that volatility is not constant. So whenever you are studying time series modeling, you must have heard of this phrase that volatility is not constant or volatility clustering. This is exactly what it means, and I'm showing you this in Excel from a raw time series data, so that you actually understand how the data looks like and why is this a problem when you are modeling, when you're creating this time series model. So what it means here is volatility is not constant. Means if I told you that yesterday saw a very large return, you should expect that tomorrow should also have a large move, even if you have no idea whether it'll be a positive move or a negative move. The size of moves is predictable even when the direction is not. And that gap, direction being unpredictable but magnitude being predictable, is the entire justification for GARCH modeling. And ARIMA captures structure in the conditional mean. GARCH captures structure in the conditional variance. And we need both to describe a return series properly. Okay, now let's come to the third section of stationarity. Now, first, what is stationarity? A time series is stationary if its statistical properties don't change over time, which means the mean stays constant, variance stays constant, and the way values at different points in time relate to each other, that stays constant. So think of it as a stationary time series bounces around a fixed center. And suppose you cut the series in half and computed the average of each half, you would get approximately the same number. The series has a home base it keeps returning to. Whereas a non-stationary series, that drifts and it wanders. So there is no level it tends to return to. If it ends up at 1000, it might just keep drifting higher. If it falls to 500, it might just keep falling. There is no anchor. And almost every classical time series model, ARIMA, regression, VAR, that is vector autoregression, that they all assume that the data is stationary. Now, this is a super important assumption for all time series models, for many time series models. And if you feed a non-stationary series into these models, you get spurious regressions. The model finds like strong looking correlations that are purely accidental, and the numbers look they look meaningful, but they are actually not. So you should always understand the assumptions for time series models, and that's why there are a lot of tests to be run on any time series data before you apply any model. Now let's talk about random walk, which is the classic non-stationary process, because a lot of time series data, they are naturally not stationary. So if you look at column D, the random walk, the formula is simple. Each value equals the previous value plus a random shock. Now if you press F9, the walk reshapes because this is a random variable. Now, if you press it again, you get a completely different shape. Sometimes it drifts up, sometimes it drifts down, and sometimes it meanders sideways. And every time you refresh this, you get a new random walk that looks plausible and convincing, but each one is completely different. So now this is the problem with non-stationary data. There is no fixed center. Whatever level it ends up at, it could just keep going from there in either direction. No model can usefully predict where it ends up because there is nothing to predict toward. And price data behaves exactly like this. That's why you must have heard of random walk and price data, and it's actually forming the basis for stochastic calculus, Brownian motion. Okay, so what is the fix? Now we look at column E, the first difference of the random walk. That is just today's walk value minus yesterday's walk value. That is the difference. And see what happens. The first difference is exactly the random shocks in column C. That is the stationary white noise. So, by taking the first difference of a random walk, we recover a stationary series. So, this is the mathematical relationship between prices and returns. The log return is defined as the natural log of today's price divided by yesterday's price, if you recall. That is identical to the natural log of today's price minus the natural log of yesterday's price. In other words, the first difference of log prices. So that's why log prices are non-stationary random walk. Their first difference, the log return, that is stationary. So just by differencing, you get a stationary time series. Now, this table gives you 4 series to compare. Column C is random shocks, stationary white noise. Column D is the random walk, which is non-stationary, it drifts everywhere. Column E is the first difference of the walk, which recovers stationarity exactly. And column F is our simulated time series, simulated return series, which is again stationary. It looks identical to the random shocks. And column G shows what happens if you compound those returns back into a price level. It drifts just like the random walk. Now, if you press F9, that is refresh the numbers, you can see columns C and F, both reshuffle and like both, but both always look like noise around zero. The random walk in column D reshuffles into something totally different every time. That is stationarity. Column D does not have it, and column C and F do. So the takeaway here is always model returns and not prices, because many of these time series models, they assume stationarity. So you want your time series to be stationary. Now let's look at this important section of autocorrelation. So autocorrelation means how much a series is correlated with its own past values. At lag 1, it asks how correlated is today's return with yesterday's return. At lag 2, how correlated is today's return with the return from 2 days ago, and so on. We call this function the ACF, that is the autocorrelation function. It gives you a number between -1 and +1 for each lag. A value close to 0 means knowing the past value at that lag tells you almost nothing about today. And a value far from 0 means there is real linear relationship which is worth capturing. Now, since we're doing this in Excel, let's try to use the functions built in Excel. And when we go to Python notebook, we will look at the functions which are used in Python. So in Excel, the formula is using this function called correlation, CORREL. To get the lag 1 autocorrelation, you pass CORREL the return series shifted by one row against itself. So if your series, if your returns are in column B starting at row 4, you write CORREL of B5 through B253 against B4, which is the previous row, through B252, which is the last but second row. The shift of one row is what creates the 1 day lag. For lag 2, you shift by 2 rows, and then so on. This is the entire ACF calculation. Just a correlation formula with a shifted range. And this is what happens under the hood in your Python functions for autocorrelation. And that's why I like doing all this in Excel, because it actually shows you how it all functions under the hood. Now look at the first table. These are autocorrelations of the raw log returns at lags 1 through 10. Lag 1 is roughly minus 0.17. The rest are close to 0. A value of minus 0.17 sounds like it might be meaningful, but look at r squared. That corresponds to that. So r squared is the square of the correlation, which is about 0.03 or 3%. So knowing yesterday's return explains about 3% of the variance in today's return. And the other 97% is pure noise, like I had mentioned before. Now, you might notice the table flags lag 1 as not near 0 because it exceeds the threshold we had set. So, but economically, 3% predictive power is negligible. That is the distinction between statistical significance and practical significance. And this is something you will encounter in quantitative analysis. And that's why ARIMA, when fitted to returns, that finds almost nothing. There's almost nothing to find in the mean. There's always something to find in the volatility or the variance, which is why GARCH is used. Now, looking at the second table, same lags, but this time computed on the squared returns. The values are clearly positive and they decay slowly across lags. Lag 5 is still positive, so this is a completely different picture from the raw returns table. Remember what squared returns measure? They measure the magnitude of the moves and they ignore the direction. So the fact that squared returns have strong positive autocorrelation, what does it mean? That if today had a large move, tomorrow is likely also to have a large move. The magnitude of returns here is predictable even when the direction is not. And this exactly is volatility clustering. Here we have confirmed this numerically. And this is exactly what GARCH is designed to capture. So the contrast between these two tables is the motivation for ARIMA plus GARCH framework. ARIMA models the mean, it finds almost nothing. GARCH models the variance and it finds a lot. And you need both models together to get a complete picture. Now let's come to the ARMA and ARIMA models. So what is ARIMA? It stands for Auto-Regressive Integrated Moving Average. It is a model for the it's the model for conditional mean of a time series. So the notation is ARIMA PDQ, where P is the number of autoregressive lags, D is the number of times we difference the series, and Q is the number of moving average terms. Now let's break ARIMA into three components so we can put them together later and understand this well. Let's look at the AR model, autoregressive model. Now an autoregressive model of order P, it says that today's value is a weighted sum of the last P values plus a random shock. So for AR1, the simplest case is yt equals phi times yt minus 1 plus epsilon, which is the random shock at time t. So this has one lag, one coefficient. And the coefficient phi, that controls how much persistence there is. If phi is 0.7, it means 20, it means like 70% of whatever happened yesterday carries into today. And high phi means the series has memory. It moves smoothly and deviates slowly. Whereas a low phi value means it forgets the past quickly and bounces more freely. There is also a stability condition. Phi must be strictly between -1 and +1. If phi equals exactly 1, you have a random walk, which means no stationarity. The series is non-stationary. If phi exceeds 1, the series explodes. You don't want that. Look at cell C1. This is where phi is stored. The simulation in column C uses exactly this formula. So C5 equals phi in C1 times C4 plus random shock in A5. Every cell in column C is just that formula repeated. So if you change phi to 0.3 and watch how much less smooth the series becomes. if you change it to 0.95 or very high 5, um, the series becomes very persistent, almost like a slow drift. Now, coming to moving average, MA. The moving average model is different in a subtle but important way. So instead of depending on past values of y, it depends on past random shocks, which are the epsilons. MA1 means yt equals epsilon t plus theta times epsilon t minus 1. That means today's value equals today's shock plus a fraction of yesterday's shock, which was not happening in AR model. The MA model has finite memory. After exactly q lags, the effect of a shock disappears completely. And this is called a finite impulse response. Compare that to the AR model, where a shock theoretically affects all future values, but with diminishing weight. That is an infinite impulse response. And MA has a finite impulse response. Again, because the effect of the shock disappears completely. Also notice that any MA model is always stationary regardless of that theta value. There is no stability constraint needed here. And this is one important difference from AR model, where you need that phi parameter strictly to be inside the unit interval. So cell E1 stores theta for this simulation. The formula is in column D. D5 equals G5 plus theta times G4, where G is the column of random shocks. And if you try changing theta and watching what happens, the series responds to shock history but forgets it quickly. Now, coming to the I component, which is the integration component, which makes ARIMA. The I in ARIMA stands for integrated, and it refers to how many times we need to difference the series to make it stationary. So ARIMA is AR and MA with an integrated series. So D equals 0 means the series is already stationary. So use the data directly. This is what we do with returns. Assume D is equal to 0. D equals 1 means we need to difference it once. This is what we do with prices. We take the first difference, which gives us returns, and then model that stationary series. Because if you remember, prices are not stationary and returns are stationary. Column E in this tab shows a random walk, which is non-stationary. So here D will equal 1. Column F shows the first difference of that walk, which is stationary. And so we are back to white noise. Now for our return series, D equals 0. The data is already stationary, so we do not difference it before modeling. Now let's see the combined ARIMA 101 fitted to the return series. Now look at the right side of this tab. This is where we fit ARIMA 101 to the actual simulated return series. AR order 1, no differencing, MA order 1. This is the 101 in the ARIMA function. Column J is the actual return at each observation. Column K is the AR1 fitted value. So phi hat times the previous return. Column M is the MA1 fitted value. Column P is the combined ARIMA 101 fitted value. The AR coefficient phi hat is approximately minus 0.168. How do we get that? It is the lag 1 autocorrelation of the full return series, which we computed using CORREL. This is actually a method of moments estimator for AR1 because we need some approximation for phi. So we base it on the autocorrelation, the lag 1 autocorrelation. The MA coefficient theta hat is approximately minus 0.173, and that comes from a moment condition that inverts the lag 1 autocorrelation using the formula theta equals 1 minus the square root of 1 minus 4 times rho 1 squared, all divided by 2 times rho minus 1. And we apply this directly in Excel. And again, there are a lot of ways to compute these approximated values. Now look at R squared for the AR1 model. It's about 3%. The model explains 3% of the variance in returns. The other 97% is noise that the model cannot capture. Now, you would ask if this is a bad model. Not exactly. It is an accurate model. The data does not have strong mean predictability. The model that claimed R square of 50%, that would overfit. That would be an overfit or it would be wrong. So this does not mean that ARIMA has done everything it can for this data. Whatever structure is left in the data, the structure in the conditional variance, which I was mentioning earlier, for that we need GARCH to capture it. And this is exactly what our next section would do. So it all depends on the kind of data series you are working with to decide what model is good for your data series. And that's why knowing assumptions of all these models and doing all of these tests is going to be so important. Now, this is a very simplistic structure to decide whether this GARCH model is appropriate or not, but this is a good foundation. Now let's move to the next section and the last section of this project in Excel, which is GARCH. We'll look at what GARCH model is here and a small application of it. Now look at column E on this tab. The rolling 20-day standard deviation of returns annualized. This is the simplest estimate of volatility. You just compute the standard deviation over a window of 20 days and use that as your risk estimate. Now, if you scroll through the values, you see on calm days early in the series, the rolling volatility is around 10 to 13%. During elevated periods, the column is flagged with a marker, and the rolling volatility climbs to 20, 25, even 30%. That is roughly a 3 times swing in volatility across the year. A risk model that uses constant volatility, like a fixed historical average, would badly underestimate risk during high volatility periods and overestimate it during calm periods. It would be wrong most of the time, just in different directions. And that's why we need a model that updates its volatility estimate dynamically. That is GARCH model. And we'll come to what it is. But this is the intuition of why a GARCH model is needed for volatility. It is because constant volatility does not work, and you need a time series model for volatility itself, which can update itself. So what is GARCH? Generalized autoregressive conditional heteroscedasticity. It sounds complicated, but it's actually a simple idea. Think of it this way. We observed that large squared returns, they cluster. Big moves follow big moves. The GARCH model says, let's directly use yesterday's squared return and yesterday's estimated variance to predict today's variance. So the GARCH 1-1 equation is sigma squared at time t equals omega plus alpha times epsilon squared at t minus 1 plus beta times sigma squared at t minus 1. So three parameters. Omega is the long run variance floor, means the minimum level variance tends to revert uh, toward the minimum level uh, towards which the variance should revert. Alpha is the news impact or that arch term, how much yesterday's actual squared return changes today's variance estimate. Beta is the persistence term, how much yesterday's variance estimate carries into today. And now in this workbook, omega is very small, this value. Alpha is 0.1, beta is 0.85. Now if you notice that alpha plus beta equals 0.95. The closer this sum is to 1, the more persistent volatility is. So shocks take a long time to decay. The fact that alpha plus beta is less than 1 is important for stationarity of the variance process. Now, the GARCH model is a recursion. To start that, we need a seed value for the initial variance. So cell I4 uses the unconditional long run variance, omega divided by 1 minus alpha minus beta. For our parameters, this is that small value divided by 0.5, which equals again a very small value, 0.00006. Then every subsequent row uses the recursion. So cell I5 equals omega plus alpha times squared return in the previous row plus beta times the previous GARCH variance in column I. Column J takes the square root of the GARCH variance and multiplies by 100. And that is the daily volatility in percentage terms. Column K annualizes it by multiplying by the square root of 252, which is the number of trading days in a year. That's how you annualize any volatility, by multiplying by the square root of 252 or 250 in some cases. So if you try changing alpha or beta in the parameter cells, you observe some changes like this. Now, when you increase alpha, the GARCH variance becomes more reactive to recent shocks. When you increase beta, it becomes more persistent and smoother. And this is built into that equation. So the parameters tell the model how to weigh today's news versus the history. Okay, so now that we have this time varying volatility estimate from GARCH, which by the way is a time series model which you just built for volatility, we can now build time varying risk measures. So now since you've built a GARCH model from scratch, let's see an application of it. We can, which is building time varying risk measures. And one of the risk measure is value at risk. So value at risk is at 95% confidence level, for example. What value at risk says is that on any given day, there is a 5% chance that the loss will exceed this threshold. We estimate it using the formula 1.645 times sigma GARCH. Now this multiplier 1.645 comes from the standard normal distribution. At a 95% one-tailed confidence level, the critical value from the normal is 1.645. Multiply by that by the GARCH daily volatility, and you get today's 95% VaR estimate. The 99% VaR uses the multiplier 2.326. which is the corresponding normal critical value. Now, because GARCH volatility changes every day, the VaR changes every day. So during calm periods, VaR might be around 1.1 or 1.2%, but during stressed periods, it might climb to 3 or higher. That's 3 times swing in volatility, which directly translates into a 3 times swing in your risk estimate, which is what is expected and should be, because your risk model ideally should capture this volatility variation. And that's why your volatility coming from a GARCH model is strong, and it's directly applicable in risk modeling. Now, the next column shows expected shortfall, and this is also called conditional value at risk. So VaR tells you what is the loss threshold what is the loss threshold you exceed 5% of the time. Expected shortfall tells you that on the days you do exceed that threshold, how bad is it on average? So expected shortfall is always larger than VaR. Under normal distribution assumption we are using here, expected shortfall at 95% is approximately 2.06 times sigma. Expected shortfall at 99% is approximately 2.67 times sigma. Expected shortfall is the more informative risk measure because it tells you about the severity of tail losses and not just the frequency. And this is why the Basel III regulatory this framework for banks, it requires expected shortfall rather than just VaR for internal risk reporting. Tells you about how severe the losses will be when you're actually exceeding that threshold. Now, building this risk model again is not enough in practical scenarios. You also need to check whether that works. So the Kupiec proportion of failures test is a formal statistical test of the VaR model calibration. So it means that if our 95% VaR model is correctly calibrated, then we expect the actual return to exceed the VaR threshold on approximately 5% of the days for a 95% VaR model. So with 250 trading days in a year, that is 12.5 breaches are expected. Now look at column R. It tracks the breach indicators for the 95% model. A 1 when the actual loss exceeded the VaR estimate and 0 otherwise. Count up those ones. Now if the count is far from 12.5, the model might be miscalibrated. What we are doing here is actually backtesting our own model which we just created. On this simulated series, the 95% model has 18 breaches versus 12.5 expected breaches, slightly more than expected. And the 99% model has 5 breaches versus 2.5, which was expected. So the Kupiec test formalizes this comparison. It computes a likelihood ratio statistic and compares it to the chi-squared critical value with 1 degree of freedom at 5% significance. Now, if this likelihood ratio statistic exceeds that degree of freedom, the model fails the test. In this case, that critical value is 3.841. So both the 95% and 99% models here pass the test. Their likelihood ratio statistics are 2.26 and 1.96, which are both below that critical value. And the brief explanation at the bottom of the table notes why there are slightly more breaches than expected. So equity return distributions have fatter tails than normal distribution, which we assumed. So maybe a student T-GARCH model would fit better. And we could extend that in our second part of the video where we are implementing this in Python, and it's going to be much easier. For now, both the models pass the formal test. So We started by understanding why we transform prices into log returns. Why we have also studied the four statistical properties that make return data look the way it does. We then established why stationarity matters and how differencing fixes non-stationarity. We then quantified autocorrelation and saw exactly why raw returns have almost none, but squared returns have a lot of autocorrelation. Then we built the AR, MA, and ARIMA models from scratch in Excel and saw that the mean is nearly unpredictable. And we built GARCH, derived daily risk estimates, and formally tested whether the model was calibrated correctly. So part 2 is going to be a Python Jupyter notebook. We work with proper simulated data set and apply everything from today: log returns, ACF, PACF, model selection using AIC, BIC, ARIMA fitting, GARCH via maximum likelihood estimation, and Python handles the heavy lifting which Excel cannot. And then you will exactly see how it all works. We can do additional tests. So I will implement this in Python in the next part of the project.